Part 2 of the financial statements, the balance sheet. A company's balance sheet, also called the statement of financial position, reports assets, liabilities, and stockholders' equity as of the end of the period. The balance sheet reports that assets equal the sum of liabilities plus stockholders' equity. This balancing feature follows the accounting equation and gives the balance sheet its name. As part of equity, the balance sheet reports retained earnings, which comes from the statement of retained earnings. The two statements we've discussed so far cover a period of time. This statement, however, is as of a single date, the date when the accounting period ends. On the balance sheet, there are two main categories of assets, current and long-term. Current assets are assets that are expected to be converted to cash, sold, or consumed during the next 12 months, or within the business's operating cycle if longer than a year. Current assets include cash and cash equivalents, short-term investments, accounts and notes receivable, merchandise inventory, and prepaid expenses. All companies have cash. Cash is the liquid asset that is the medium of exchange, and cash equivalents include money market accounts or other financial instruments that are easily converted to cash. Short-term investments include stocks and bonds of other companies that the company intends to sell within the next year. Accounts receivable are amounts to be collected from customers from the sale of goods and services. Inventory is the merchandise that a company buys and holds and then sells to its customers. Prepaid expenses are amounts paid in advance for costs that include advertising, rent, insurance, and supplies. The main categories of long-term assets are property and equipment, also called plant assets, and intangible assets such as goodwill. Long-term assets may also include other investments that are expected to benefit the company for long periods of time. Property and equipment are the tangible assets that include land, buildings, computers, furniture, and equipment. Accumulated depreciation relates to property and equipment. It is the amount of the historical cost of plant assets that has been allocated to expense in the income statement over time as the asset has been used in producing revenue. Long-term investments include stocks and bonds of other companies that the company does not intend to sell within the next year. Intangible assets are those with no physical form, such as patents, trademarks, and goodwill. As an example, here's Disney's partial consolidated balance sheets. It is dated at the moment in time when the accounting period ends, which is September 27, 2014, and September 28, 2013. The report begins by showing all of the current assets, then the long-term assets, to arrive at total assets. Liabilities are also divided into current and long-term categories. Current liabilities are debts payable within 1 year or within the operating cycle, if longer than a year. The most common current liabilities are accounts payable, accrued expenses, federal and state income taxes payable, other liabilities like short-term notes payable, and finally, current maturities of long-term debt. Accounts payable represents amounts owed to vendors and suppliers for purchases of inventory and other items on account. Income taxes payable are tax debts owed to the government. Accrued expenses include other liabilities such as interest payable on borrowed money, accrued liabilities for salaries, utilities, and other expenses that are owed but have not yet been paid. The current maturities of long-term debt contain the portion of long-term liabilities that the company will have to pay within the next year. Long-term liabilities are due and payable beyond 1 year, or the company's normal operating cycle if longer than a year. Examples include long-term notes payable and bonds payable. Here's the next section of Disney's partial consolidated balance sheets. Here we see their liabilities broken into the two categories, current liabilities and long-term liabilities. The liability section ends with total liabilities. The last section on the corporate balance sheet is stockholders' equity. The assets or resources and the liabilities or debts of a company are fairly easy to understand. Owner's equity is a little harder to pin down. Owner's equity is simple to calculate, but what does it mean? Remember that the company's owner's equity represents the stockholders' ownership of the business assets. A corporation's equity consists of common stock, additional paid-in capital, retained earnings, treasury stock, and accumulated other comprehensive income or loss. Common stock is shares issued to stockholders. This amount represents the face amount or par value of the stock. Additional paid-in capital is the amount of cash received on the initial sale of the company's stock in excess of the par value. As stated before, retained earnings is the portion of net income that has been retained by or reinvested into the business. Treasury stock represents the amounts paid by the company to repurchase its own stock from its shareholders. Accumulated other comprehensive income or loss represents items of gain or loss that are allowed by the FASB to bypass the income statement and be recorded directly into stockholders' equity. And finally, here's the last section of Disney's consolidated balance sheets. Here we see the equity section with all its components: common stock, retained earnings, accumulated other comprehensive loss, which we will not cover in this class, treasury stock, and the minority interest, which we will also not cover in this class. Once equity has been summed, it is added to total liabilities. Here's our look at the entire Disney consolidated balance sheets. As with all balance sheets, total assets must equal total liabilities and total equity.